Look, it's a fact of life. Bonds aren't as closely followed as stocks are, so they generally aren't as well understood. But by the end of this video, you're going to have a much better handle on what moves bond prices. Yes, bond prices move up and down every day, just like stocks do. You don't just buy a $1,000 bond and collect fixed interest payments every 6 months while the value of that bond stays at $1,000 until maturity when you collect your $1,000 back. That's not the way it works. The price of a bond goes up and down based upon market conditions and any developments specific to the issuer of that bond. Now, I can make a blanket statement that bond prices move inversely to interest rates. And that would be true, but it's just not that satisfying. And frankly, I don't think it really sinks in very well. So, what better way to teach and illustrate how bond prices move up and down than with a short quiz in which I present to you financial and economic news and you predict the bond price reaction? For this, we're going to use the price of an ETF that tracks the US Aggregate Bond Index. If you want to learn more about what is in the Aggregate Bond Index, watch this video here. I'll include a link in the description. For our purposes, just know that the AG ETF contains high quality US bonds. And I'm willing to bet that most, if not all of you, either have exposure to this ETF or a substantially similar ETF or mutual fund, including some of the tickers listed over here. I picked 3 real examples from the last year in which the price of the AG ETF moved up or down by more than 1%. In fact, there were only 4 days in the past year during which the price moved up or down by more than 1%. So that should give you a sense of how significant a 1% move is.
Pro tip: pretend you own the AGG ETF. Does the news presented in the following 3 examples make the fixed yield you're getting more or less attractive to you? If the news makes the fixed yield more attractive to you, then you'd buy more, which would bid up the price, and vice versa.
First up, April 10th, 2024. What happened that day? Well, the March inflation reading came out higher than expected. This caused investors to believe that interest rates would stay higher for longer, which led to US stocks falling 1.1% on the day. What do you think happened to bond prices? Bond prices fell 1.2% because if inflation is higher than expected and you want your bond return to beat inflation by a comfortable margin, then the fixed interest rate you're collecting from the basket of bonds in the AG ETF looks less attractive. So investors sell, and this selling pressure leads to the price declining. Next, we have August 2nd, 2024. This is the day that the July employment or jobs report hit the tape, and it showed an unexpectedly weak US labor market. The stock market was already jittery from the day before when stocks fell 1.5%. And on August 2nd, stocks fell another 2%. And there were also some weak earnings reports from big companies like Intel and Amazon, and that spooked some investors. What do you think happened to the price of bonds that day? Bond prices rose 1.1%. Why? Because economic weakness makes investors believe that interest rates might go lower in the near future. And so the fixed interest rate that you're collecting on the AG ETF looks relatively good if you think that interest rates are going to decline. So investors buy the AG ETF to lock in those interest rates before they decline. This buying bids up the price of bonds and in turn, the price of the AG ETF. Last up, we have December 18th, 2024. The Fed cut its overnight interest rate by 25 basis points, or a quarter of a percentage point. But instead of signaling more interest rate cuts in the coming months, which is what investors expected, the Fed communicated that it likely wouldn't cut rates soon because of resurgent inflation concerns. This sent US stocks spiraling down 3.2%. How do you think bond prices reacted? Bond prices fell 1.1%. Remember, if higher inflation is coming, you may not be satisfied that the fixed interest rate you're receiving on your bond investment is going to be enough to give you an acceptable return above inflation. So you sell, and this selling pressure leads to price declines in bonds. My goal here was to help unravel some of the mystery surrounding what moves bond prices up and down. Your portfolio has an allocation to bonds. Maybe it's 30, 40, 50%, some cases more. So I hope that you come away from this video with a better understanding of how bond prices fluctuate and what impact that has on the overall value of your investment portfolio. Thank you for watching. I'll see you in April.